Hello everyone and welcome to another episode of Investment Academy. In this series of personal finance, we have learned about how you can enhance your financial stability through different measures. Tax planning is another such measure that can work wonders for you if you are doing it right. And of course, who doesn't like saving on taxes? So let's start with the topic of tax planning and find out ways in which you can save on taxes while enhancing your financial stability. First, let's explore the various types of taxes that individuals are subject to in India. The primary tax is the income tax, but there are also taxes such as capital gains tax, property tax, professional tax, and taxes on other sources of income. Each category must be understood for accurate tax filing and planning. Key concepts like exemptions and deductions under various sections of the Income Tax Act, such as Section 80C to 80U, significantly impact the calculation of taxable income. Now let's understand how the income tax is calculated in India. To calculate, you only need to add up all your income, subtract the deductions and calculate the tax liability according to the tax slabs. Although it's not as simple as it sounds. In the income, you will need to consider your basic pay, bonuses and other incomes like interest on savings, dividends and rental income. This will make your gross total income. Now from this, you will need to subtract the exemptions like house rent allowance, transport allowance, standard deduction and other applicable deductions under various sections of the Income Tax Act. By subtracting this, you will find out your total taxable income. This will be the income on which your tax liability will be calculated. But it's not that easy. There are two different tax regimes that are currently followed in India, popularly known as old tax regime and the new tax regime. The new tax regime, introduced in the financial year 2021, offers lower tax rates but allows fewer deductions compared to the old regime, which includes various deductions like HRA, LTA, Section 80C, etc. The new tax regime simplifies tax slabs, increases the tax rebate limit and includes a standard deduction for salaried individuals and pensions. It suits the individuals with fewer deductions, while the old regime may benefit those who can claim more deductions. These are the two different tax slabs for new and old tax regime in India. In the new tax regime, income of up to 3 lakh is tax exempted, but a rebate of rupees 7 lakh and with 50,000 standard deductions, income of up to 7.5 lakh per year is tax exempted in the new tax regime. In the old tax slab, income above 2.5 lakh will be taxable, but with the rebate of 5 lakh and 50,000 standard deduction, income of up to 5.5 lakh will be tax exempted. Now if you are wondering whether old or new tax regime will be good for you, so I can make it simple for you with some rough estimates. If your deductions through investments in ATC instruments, HRA, LTA, ATD, ATE, etc. are less than 1.5 lakh in total, then the new tax regime will be beneficial for you. If your deductions are more than 3.5 lakh, old tax regime will be very beneficial for you. And if your deductions lie between 1.5 lakh and 3.5 lakh per year, then it depends on your income and tax-saving investments that you have chosen. There are various calculators on the internet that can help you calculate your tax liability. This liability or the amount of tax that you need to pay gets deducted from your income every month from your salary and paid to the government. So that was the process of tax deduction. Now comes the important part, which is how can you reduce your tax liability and make the most out of it. Tax planning largely depends on your income. If your income is less than 7.5 lakhs, you can directly choose the new tax regime while filing your ITR and you won't need to pay any income tax. If your annual income is more than 7.5 lakh, you can avail tax benefits by various measures. Here is a calculator that I will be using to explain you how much taxes you can save through old and new tax regime. Let's assume your CTC is rupees 15 lakh per annum. In this, the first thing that gets deducted is the employer's contribution towards EPF. You must note that yours as well as your employer's contribution are deducted from your CTC to calculate the taxable income. This will give you your gross salary. Now from this, we will reduce the annual house rent allowance HRA and leave travel allowance LTA. You can check this in your salary slip. You can also declare the children's education allowance, which is 100 rupees per kid per month, and the children's hostel allowance, which is 300 per kid per month. Now comes the deductions. First of all, standard deduction of 50,000. Then comes section 24, which is interest on home loans up to 2 lakhs. Section 80C involves a list of multiple tax saving instruments that can help you reduce the total taxable income by up to rupees 1.5 lakh per year. Section 80C includes ELSS, EPF, PPF, ULIP, life insurance premiums, etc. If you are a taxpayer, you must avail benefits of Section 80C instruments. If you can take market risk, ELSS can be a very good option as it generates returns and reduces the tax liability at the same time. Next, we have NPS, National Pension Scheme, that works as a pension plan, and individuals can save up to rupees 50,000 from their taxable income while building a stream of income for their post-retirement era. Section 80D allows you to take advantage of the health insurance premium on your tax planning. If you pay the insurance premium for your family members, you can deduct the premium amount from your taxable income. Interest on education loans also gets deducted from taxable income without any limit through Section 80E. Lastly, if you have purchased an EV on loan, then the interest amount on that loan can also be reduced from your taxable income. Now, what remains here is your taxable income after considering all the deductions under old tax regime. In this case, you don't need to pay any tax as taxable income is less than 5 lakh. Now, if we do the same calculations in the new tax regime, only 2 deductions will be applicable. First one is the standard deduction of rupees 50,000 and another one is EPF contribution of you and your employer. This makes your taxable income very high and you might have to pay much higher tax compared to old tax regime. However, if your income is less than 7.5 lakhs, then it will be more beneficial. So that was all about tax planning in short. I hope that after watching this video, you will know which tax regime is better for you and how can you reduce your taxes for effective financial planning. We will be coming up with more such informative videos. Until then, happy investing.
Investments in securities market are subject to market risk. Read all the related documents carefully before investing.